GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's got the same energy as a 12 seed ready to bust brackets in March Madness. I'm your host, Jay Hamilton. It's Tuesday, March the 19th. And we've got William Quigley back on the show with us. Now, we had William on a few times before. On October 4th, Bitcoin was sitting around 60K. William predicted we would be at 100K by the end of the year, and we were. Then in December, William came back on and predicted 200K Bitcoin by March, April, 325K by the end of the year. So we're maybe a little bit off track on that, but we're going to get an update from William today, see where he thinks we are in the current market cycle. Where is the bottom? Do we have much more to go? And what his outlook is for the rest of the year. Now, William is one of the co-founders of Tether, also co-founder of Wax Blockchain, a leading bridge technology project. So it's always a pleasure to get him on the show. Now, before we jump in and hear from William, March Madness starts tomorrow, and the Milk Road loves to celebrate and compete against each other. So we've got a Milk Road March Madness bracket. Make sure you hit the link in the show notes, fill out your bracket. It's free, and you can win a bunch of cool prizes worth thousands of dollars. Also, today's episode is brought to you by Definitive Advanced Trading on every chain. It's also brought to you by Coinshift, powering top crypto treasuries with their yield-bearing stablecoin, CSUSDL. Without further ado, William, welcome back to the Milk Road Show.
Hey, thank you.
Great to have you. Okay, let's start with an update of what's happened in the past few months and what happened to our post-halving bull cycle that we all thought would come. It didn't seem to play out the exact same way it's played out in past years, or maybe you think it has and we're just slightly off.
No, it definitely hasn't. And I would just say one thing. I never make predictions about where crypto prices are going. What I do is I say, if past patterns persist, then blah, 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 right? So if past patterns persisted, Bitcoin right now would probably be at 150,000. Ethereum would be at 6,000 or 7,000. By April, Bitcoin would hit 200,000. Bitcoin or Ethereum would hit around 10, Bitcoin around 200, but that's only if past patterns are persistent. And I have no idea if they will be or won't. I make bets as though they will. And I do that because that's all we have with crypto. Despite what everybody would hope, cryptocurrencies trade on sentiment. They don't trade on profits. They don't trade on user growth, adoption. They trade on sentiment. And so what would be useful here, I think, is saying, all right, if you look at the past three halvings, post the year following the halving, you had tremendous growth in Bitcoin. Everything follows Bitcoin, right? So if Bitcoin doesn't go up, then none of the other tokens do either. And so Bitcoin was at about 60,000 in October, 100,000 roughly in December 2024. And now it's bumping around between high 70s and like maybe 90, right? Somewhere around there. And the part that's always hard for, especially in the crypto area, is when we look at news, what we think should be important news. And of course, in the US, that would be the amount of positive rhetoric coming from the Trump administration over, the past month and a half. But that's not translated into anything as any real price appreciation. I'm going to guess that's mostly because it's rhetoric as opposed to actual policy implementation. And then if we look at even 2020 and certainly the halvings before that, I would say the monetary policy regime at that time in the world was generally quite favorable. And in this time around, we have a very different scenario. We have high interest rates making things like fixed income securities relatively more attractive. And we also have a sentiment, I think, in the US, certainly, that a recession is coming. And now that institutional capital is much more important than it was, let's say, in 2020. And because institutional capital, what we call Wall Street, is very quick to reduce their exposure to what are considered high-risk assets in a time of economic slowdown, we see, I think, a lot of institutional capital reducing their position in certainly Bitcoin and then the others. And it's very hard to fight that because there's a lot of money in institutions. We still have with ETFs $100 billion of Bitcoin traded in ETFs, 6 billion or so traded in Ethereum, and as long, I think, as there are concerns by Wall Street that the US economy might be slowing down, it's going to be hard to get institutional capital to rotate back into crypto. And so for now, seems to me we're stuck in sort of a trading range. And you had, at the end of last year especially, you had a lot of buying by MicroStrategy, and it doesn't take that much. It doesn't take that much fiat purchasing in order to drive up the prices of Bitcoin, and then, as I said, everything's connected to that. So it seems to me that's the situation we are in today. There's a lot of implications to that. If Bitcoin doesn't follow its prior pattern, and I think in the last time we talked, I said for that to happen, Bitcoin would have to, at some point in 2025, hit roughly 325,000 or higher. Ethereum, the one that's even harder to imagine, it would need to hit 20,000. Basically, those predictions, though, are based on certain timeframes within 2025. So come April, as you mentioned just at the opening, if Bitcoin isn't at roughly 200,000, Ethereum maybe 10,000, I would say it's going to be hard for Bitcoin to hit at the end of this year or near it over 300, and certainly for Ethereum to get above 10,000, let alone 20. And everything else really follows from that. You're not going to have a rally in the altcoins where Bitcoin is flat. At least we've not seen it.
No. I mean, and certainly not this past year when Bitcoin's been the only one that's having a rally, and altcoins have been pretty much a whole bucket of shit coins this year, and not many altcoin trades have done well this year, unless you got in very early a few years ago when the FTX bought.
Right, in the absolute lows, right? Yeah. But that means it's people are in these cryptos because they want extraordinarily higher returns, and they accept the volatility as a result. But they want those returns, very high returns, relative to other traditionally traded assets. If Bitcoin and the other cryptos are not moving up that much, particularly during a period where we're expecting a bull market, then you are going to have a lot less interest from institutional capital for sure. That's why this is a pivotal year for Bitcoin and the other cryptos. If this year, the post-halving supposed bull market year, is not interesting, if it's flat, I could see capital rotating out, because if it did follow the patterns, we'd be waiting another 4 years.
Mm-hmm.
You know,
Mm-hmm.
it's a long time to wait in an asset that's so volatile.
So let's talk in maybe two phases. One, we're in this period of chop. As you said, we're ranging between 70 to 90 on Bitcoin. And let's just focus on Bitcoin for now, and then we can talk about some other tokens afterwards. How long do you think that we could be in this period of chop for? What are the catalysts or the things that you're looking for that would change us out of this current chop and get us into, I mean, ideally 100, 109, and actually get us above all-time highs again and get us going again? Do you think that happens this year? Play out the rest of the year for us.
Well, it's really straightforward. There needs to be substantial and consistent buying of Bitcoin. You know, if you solve Bitcoin price problem, then everything else follows from that. That's what you need. Michael Saylor was doing that, you know, at MicroStrategy. He was doing that in late last year. You also had a lot of institutional capital rotating in, thinking, okay, this is this year where we should see things pop. I had played it back and forth many times with my team. If everybody is following the same pattern, you know, looking at what's happened historically, how does that play out? Because everybody can't be, you know, winning. That's not how it works. If everybody has the same trade, you either get a very, very ugly scenario where everybody wants out, or the opposite, you know, where things just go really, really high and eventually you run out of new capital and then the market stutters. So I think nothing happens until the overall economic outlook becomes very positive. And I don't know if that's going to happen in 2025 because, you know, the Trump administration, obviously, you know, everybody knows they're doing a lot of renegotiations with their international partners. And we've seen some retaliation against that, and tariffs in particular areas. Stock market basically doesn't like the protectionist mindset. Now, this might be very good for the Trump administration. It might be good for particular groups within the U.S. economy. Certainly, you know, if you're a manufacturer and you had offshore competitors, this might be a good thing for you. But overall, I think the stock market doesn't like it. And until that changes, which would basically mean a reversal of Trump's trade policies, I don't see the S&P rallying, and therefore I don't see, you know, Bitcoin rallying. That's, you know, it's a high risk asset. And in times of uncertainty, people flock from those and they go into, you know, bonds and other things that they find more secure.
Mm-hmm. Yeah, it's interesting at times like this, because I think to everybody in crypto, we say, oh, well, Bitcoin's digital gold. Well, it should be trading like gold. But in times like this, Bitcoin's still not there. We're not trading like gold. We're trading much more correlated to equities in the S&P 500.
Yeah, and that you're right. And so really we need to update that narrative, because that has been the narrative, right? It's digital gold. But at the end of the day, when you look at, you know, if you go back 5 years, 10 years, when Bitcoin and the other crypto were really in very, very limited holdings around the world. Most people, especially institutional capital, wouldn't touch it. But the idea was, I remember even in 2020, talking to Wall Streeters, and one of the talking points I had was how it was uncorrelated to S&P 500 and other market performance. It was very nice. It did look a lot like gold from that perspective. But what is odd is when institutional capital buys gold, they think of it consistently as a counterweight to maybe an economic downturn or a time of war, flight to a more protected asset that will hold its value during economic uncertainty. Bitcoin was supposed to be similar, but the reality is just Wall Street doesn't look at it that way. And despite the fact that that's what it was made for, if Wall Street doesn't look at it that way, then it becomes more like, when I think of my venture capital background, like a recent IPO. When the markets have been going gangbusters for 9 months or a year, that's when the bankers come out and say, take your companies public. The market is excited, it's risk on, and they're willing to take some flyers on some new technology. As soon as the market starts to slow down, the first thing to shut is the IPO window. And then the market starts to dump its recent IPO companies because those things haven't stood the test of time yet, right? They're new. And I feel like Bitcoin has been put into that bucket, sort of the recent IPO or the very high risk and potential high return bucket. And that's why right now you don't see a lot of rotation into it. The trading volumes haven't been bad relative to the past, but we peaked at about $3 trillion monthly for the top 10 or so exchanges in December, and then we've been going down. January was like 2 trillion, February $1.5 trillion, March is like, I think it'll come in about 1.2, 1.3 trillion. So we're at half the trading volume, monthly trading volume, as we were in December. So, you can't expect a rally when you've cut the volume by more than half.
Mm-hmm. Yeah. Let's talk about your views on the US economy. So there seems to be two camps here. One camp is Trump wants a growth scare without a recession. Basically, like let's get the maximum growth scare, let's reduce stocks, reduce the asset markets, and then allow for a setup where he can run for the rest of his presidency. Or there's others that say, okay, we're going into recession and this is going to happen. Where do you sit?
Well, first I would say Trump he hasn't said the words, I'm okay with the recession. What he has said is, we're going to have some short-term pain. We're going to have some short-term problems. He said that, which I take to mean we may go into a recession. And he's vocalizing that, and he's saying at the same time, but I'm maintaining my approach, my policy approach with respect to international trade, and with respect to reducing federal spending. The federal courts have become so damn chaotic. Their random federal judges are constantly trying to overturn the executive branch decisions. Mm-hmm. A lot of his attempts to reduce the budget, I think, are being stalled as a result of that. But you also have to understand, if the U.S., the government is a component of GDP. So if you slow government spending and the private sector doesn't offset that, then of course growth will slow as well. So my sense is the current administration is not going to do everything to keep the economy growing. The Fed, they've been pretty consistent. They're starting to reduce rates. We've cut whatever it is, 75 basis points so far since like October. But we're at between 4.25 and 4.5%. I'm an older guy. Those rates look amazing to me. I would like those rates to basically stay where they are. I don't like the idea of certainly not going to zero, but even going to 2 to 3, 2.5, would prefer not. I think these rates are reasonable given time value of money and risk and whatnot. And I think the U.S. economy can easily deal with rates this high. So I see, though, that we were doing really well because we pumped 8 trillion or so of monetary policy into our economy post-COVID, and that's all been, for the most part, absorbed. And now we're going to have to grow based on just the traditional things that we do. Trump may get some tax legislation in, though I suspect that will be aimed at moderate earning people, and the wealthy, called the top 10% of U.S. earners, drive more than half of domestic spending. So unless you're targeting them and they feel like they have more money in their pocket, you're not going to get a lot of economic stimulus from reducing taxes on lower income or even moderate income people. So while I think that will be well received by his base, I don't think that's going to do much for the economy. We need true economic growth. I have a incredibly positive outlook for the U.S. economy over the next 25 years. I think it will be extraordinarily rewarding for companies in the United States. The end of globalization is probably a huge benefit to the United States because it is deemed a very secure place to invest. It's a very large market and a very interesting market because it, relative to the rest of the world, very high earning. Everybody speaks the same language. Everybody watches the same content. It's easy to reach U.S. consumers, which is why everybody likes our market. And so that is super positive, especially when you add on to that a need for massive infrastructure investment. Just regardless of the climate change stuff, we need to upgrade U.S. national infrastructure, and that'll have great benefits. So I'm super positive long term, but I think we will have the first 2 years or so, the Trump administration is probably going to be pretty modest growth.
So you see this could last a few years. This could be, yeah.
And I we're in. It's both fascinating and scary as a crypto person that if we go off trend, which I would say, as I keep saying, if Bitcoin isn't at roughly 200,000 in April, I think we'll be off trend. Then we're in who knows. That it's more random. One of the things it's worth observing here is that we don't hear a lot about this word utility. That word used to always be associated with, oh, why is this going to go up? Utility. Meme coins kind of stamped any trace of that word out of the lexicon of crypto people. It was becoming a bit of a fig leaf anyway, because by my definitions of utility, I saw no recognizable pattern between that and then, let's say, you look at the top 100 cryptos. There's a lot of cryptos in there where the teams have abandoned the project, or the founders were indicted and put in jail, and those things are still trading. And so I think a lot of cryptos are frankly kind of meme coin-ish in the way they just have a fan base. I might have mentioned this in the past on your program. VCs and institutional investors, they really like to be thought of as logical, right? And that they have an investment approach. And so when I ask those investors, do you think metrics matter as an investor? I mean, like it's a rhetorical question. They're like, absolutely great. How about the use of a chain? The use of a chain, would that be an important metric? Absolutely. Okay. What are the top
What are you doing
things by usage?
Yeah.
You know, and it's always a blank stare. Like, so I don't actually think the institutional investors, the crypto investors, really look at metrics. I think what they look at is momentum. Mm-hmm. And that's why this could be a little scary, because at least we had prior patterns in the past, right? We would say, okay, this is how it normally goes. I don't know why it does this. It's like the credit cycle in the real world economy, but it does. Right now, if we don't have the expected 2025 bull market, then we won't have a lot to go on. You know, we can turn to, well, let's see about adoption and, you know, usage. But if that's not something that's going to drive these crypto prices, then I don't know what will. We may be in a period where people are just reassessing how to think about this category. You know, again, if you're in an asset that's incredibly volatile, the only reason you're willing to do that is because the upside is so high. But you know, if we have to wait another, you know, if we have to wait till 2028 for the next halving, that's a long time to sit in a volatile asset. So I'm still long, and I still, you know, I love the crypto space. It's a lot more interesting to me than, you know, traditional stocks. But I might have to adopt a different approach to my investing in this area if this halving comes and goes. But
yeah, well, and you make a good point. Like like it or not, our best sales tactic or our best marketing in crypto is prices going up. That is what we've got so far. Yeah, don't get me wrong. You know, I'm a bit being a bit blasé when I say that. Yes, we have stable coins, and stable coins we believe in, and obviously you believe big time in stable coins. You and I have talked about this in the past, that stable coins are the bigger use case than even Bitcoin is, and long term will be used by all monetary and fiscal systems to move money. It just makes so much sense. But right now, we're still not at the point where we have the easy UX for the whole world to all of a sudden onboard to stable coins. We're going to get legislation in the US, and like that sort of stuff is going to happen. But right now we're still in this period of like, we need prices to go up because that's what attracts new investors. That's what brings people into the space. And so you're a little bit concerned. Are you? So it's interesting. You're still long. Are you repositioning your portfolio? Are you hedging short right now, or no?
No, I have not. I never short.
Okay.
I just constitutionally, I've never liked that. The idea of having, you know, sort of a infinite loss potential is not, even as an early stage VC, that doesn't exist, right? We manage our loss potential by how much money we invest.
Put in.
So in something that's where prices are so driven by sentiment and emotion, I think shorting is really scary. So I don't short. For me, and this is something, whenever I get together with crypto investors, we talk about this. If you were to reduce your exposure to crypto, where would you put that capital?
Yeah, good question.
And real estate is still inflated. Maybe you could go into commercial real estate. That's not an area I really know and understand, so I'm not going to do that. And that's much less liquid. And then stocks are still quite expensive. The S&P 500 Schiller PE ratio is at maybe 28. It's gone as high as 35, but that's elevated. In a bear market, you would like, 10, 12, 13. So we're still 2x that. So the S&P 500 is pretty darn valued, highly valued. Yeah, it might not be overpriced, but
might not.
I don't think it's a deal.
Yes.
And then fixed income. So government debt looks pretty good, right? You can get 4+%. And of course in private credit, you see there's a lot of interest there. It's a golden age right now for private credit. You can get 6-7% on pretty good bonds. So that's an alternative, but there's no real massive upside in that type of investment either.
No.
So I come back to what I like and what I know. There's great liquidity in crypto, but this is usually the when springtime for crypto, and it hasn't happened yet. So I'm still engaged and deep in, but I have to also wonder if we don't get that bull market, or let's say we get to 150,000.
Mm-hmm.
What I would tell you, just as an investor, I would say, you doubled your money, let's say, in Bitcoin during the bear market run or the bull market. That is not enough to justify the volatility that you take on with Bitcoin and the other cryptos even more so. It's just not enough. So I hear a lot of people say, wow, 200,000, that would be great. Yeah, that's like a 3x from where it was pre-halvening. It was like 65,000 at the halvening in April 2024. So if we got to 200,000, I assume a lot of people would say that's great, but that's 3x. That's not enough. The reason I was looking at 5x, which is over 300,000, one, that would be kind of what the pattern would suggest it would do, but also that's sort of what you need. You need to justify it. And then Ethereum needs to do double that, So Ethereum's pretty risky relative to Bitcoin. So you'd like to have 2x the potential. So if Bitcoin needs to do 5x during the bull market, then Ethereum needs to do 10x from the point at the beginning of the halving. And that's where I got to 20,000. So those numbers are what it needs to be, but also what we should see if the past is gonna be maintained.
Mm-hmm. Mm-hmm.
I will give you one thing that's very positive for us. I'm a big believer in the Fear and Greed Index. It's never failed, right? Never failed. When Fear and Greed is above 80, you should be holding, if not reducing your exposure. When it hits 90, which would be very, very greedy, very bullish, you probably should be reducing your position. It's almost certainly going to fall. Right now, Fear and Greed is low 20s, 22, 23. That is very low. And Bitcoin at whatever Bitcoin is today, 83,000, and Fear and Greed being at 23, that's a very nice combination. If Fear and Greed were at 90 and Bitcoin were at 83, that would be awful. But it's, anything below 20 is really a lot of fear and very bearish. And we've dropped below that in the last month a few times. I think we hit 15. When it drops below 20, your audience should cheer. No one has ever lost money acquiring Bitcoin when it's dropped below 20, unless they sold it, a day later. But if you have a 1 year plus holding period and it drops below 20, that's incredibly positive. And right now it's 22, 23. Basically, it's got 80 points that it can go up, only 20 down. I like that. I think if you're holding Bitcoin right now, given that, you're in a very solid position.
All right, we're just going to take a quick break to hear from our sponsors. But when we come back, William, I want to dive into Ethereum because that has become such a non-consensus trade and something that is really getting a lot of FUD. So I want to cover that and get your thoughts on that. But quickly, we'll just hear from our sponsors who make this show possible. If you're only trading on centralized exchanges, you're not going to make it. Founded by Coinbase alum, Definitive lets you trade any token on Solana, Base, and every major chain, all in a single platform. What makes Definitive different is its advanced order types. You can execute limit, TWAP, and stop loss completely on chain. Get the best prices on every trade. Your order is routed instantly through every DEX and liquidity pool with up to 19 times lower fees. Trusted by funds, DAOs, and the milkman himself, Definitive lets anyone trade like a pro. Milk Road listeners get 0 trading fees on your first $25,000 in trading volume on Definitive. Go to milkroad.definitive.fi. Today's episode is also brought to you by Coinshift and their new stablecoin CSUSDL. Don't just hold basic stablecoins, earn yield, all without compromising security, backed by regulated real-world assets and secured by our friends at Steakhouse Financial. Put your treasury cash to work, earning native yield and protocol rewards. Built by the team behind Coinshift, which is trusted to manage over $1 billion in business treasuries on chain, including Aave, Gitcoin, and hundreds of leading institutions. CYCSUSDL is gaining traction at milkroad.com/Coinshift. And we're back to the show. Okay, William, ETH. Let's talk about ETH for a second, because ETH is a tough asset. It's been a rough, what bull market for ETH? Basically didn't have a run at all. And a lot of people fudding ETH, but then a lot of people saying, hey, it's a non-consensus trade. It feels like it could be at the bottom. It still has a lot of institutional interest. So I'm hearing a lot of views on both sides of ETH. What are your thoughts?
That's a good summary of my thoughts. My partner and I were the second largest buyers in the Ethereum crowd sale in 2014. We've held on to our Ethereum. Forget about my words, I'm long, right? Mm-hmm. Now, if I knew what I know now, sure, I would have gotten out a year ago and maybe bought in today. In the last year, Bitcoin is up 30% last 12 months. So, not amazing considering that next month is the 1 year anniversary of the halving. So up 30%, pretty weak. But compare that to Ethereum. Ethereum isn't flat in the last year. It's down 40%. Mm-hmm. The last 90 days, Bitcoin down 30%. Or roughly 15%. But Ethereum, I think, is also 40% or so, close to 40% the last 30 days or 90 days. So relative to Bitcoin, Ethereum has performed really awfully. And I think there was, particularly because of Solana and the meme coins going on Solana and, the old, now really kind of old narrative that Ethereum is slow and expensive and it's not the right place. But if you look at things like DeFi, Ethereum is, dominant. And I think if you ask most people what they feel more comfortable holding, let's say at today's prices, I know I feel much more comfortable that Ethereum isn't going to get hacked, that Ethereum is safe versus anything other than Bitcoin. And so it does have, it has launched in 2015. So 10-year history. It has an overwhelmingly larger number of developers. ETH Denver just happened, the largest Ethereum conference in North America. lot of positive energy. I think a lot of developers like building on Ethereum, particularly for DeFi. Now, this gets to like utility again, which, as we talked about earlier, doesn't seem to have a whole lot of sway when it comes to pricing. I think the narrative at the institutional level is super straightforward. They kind of got out of it at the end of the last bull run as it became clear that it had a lot of technical problems. The surge pricing model it uses to clear the queue makes it really not really a great chain for any sort of bigger companies to ever adopt and use. But it's very secure, and its smart contract system is very well designed. So you got a lot of people who still like to work on it. And I think there will probably be some cycling back into it before whatever bull market happens ends. Whether that will bring us to the last cycle's high, which was around little under $5,000, I don't know. But it would be, if I say what would be a negative, a big negative, finishing 2025 and having never gotten near its previous high of 5,000, that'd be a big negative. Now, if there is no bull market and nothing really relatively does substantially better other than Bitcoin, maybe it's not the end of the world. A legit criticism of Ethereum is that, and maybe if I was working there, I would feel differently. But as an outsider, I never have gotten the sense that the things the Ethereum Foundation funds, the development pipeline is well aligned with the desires of the crypto community. There's a lot of esoteric things we do in blockchain development, and you've got to do those to keep the chain working and scaling. But then you got to throw the red meat too, right, at the audience, because if you don't, then they're like, yeah, your technology updates. How many times have we done update this app thing? And you're like, but nothing changed. It's all just basically housekeeping, right? That is probably a problem with the foundation, the development plan just doesn't seem to be that exciting. And I humbly say that because I built blockchains. There's always stuff to do that nobody cares about, but that you have to do if you want to maintain the thing. And then, as I mentioned, Solana took a lot of the gusto out of Ethereum when all the meme coin people went there. Personally, I don't think that was a positive for Solana long term. 100 million meme coins that are just junk don't really do much for the community. So last time around, Ethereum really benefited from DeFi. Once, DeFi is a lot about leverage, and leverage happens when there's a bull market and people are feeling excited. So you could see, as you mentioned, sort of this sort of an investment that's out of the mainstream. The conventional thinking is consensus view. Ethereum's sort of a relic of history. It's going to bump around. It's never going to be interesting. I would say I wouldn't write it off just yet.
Yeah. It's certainly there seems to be a lot of the FUD that you mentioned around the vision of Ethereum and their ability to communicate and to market and to get the narrative and to get everyone excited. They haven't been able to do that as well as Solana has been able to do that. And they've gotten a lot of heat for that, but they've made some changes in the foundation and the leadership. They have some old people coming back in. Danny's back. Like, there is a bunch of changes happening that I think we could start to see some shift. I think I can't not get away from being a bull on Ethereum as it becomes more and more bearish and more non-consensus. It feels, as you said, DeFi, I was just pulling up the stats here. DeFi TVL, Ethereum's got 54 billion today. And obviously a lot of these TVLs are down from where they were 3 months ago. And Solana is next up at 7 billion. It's not even in the same ballpark, right? So
yeah, because we all trust, we trust that you get the wacko Bitcoin maxis who, I've talked long about anybody, a maxi of anything where you're a zealot is not interesting to me, but they have all kinds of criticisms. But the reality is it works. And also the reality, it's a 250 billion market cap, which is pretty impressive. But, that's 1/6 of Bitcoin's market cap, which is whatever, 1.5 trillion or whatever. So yeah, it's a fraction. But, if you look back 6 months ago, the Ethereum ETF had, call it October 2024, Ethereum ETF was about a 6 billion market cap and about 50 million in daily trading. Not that much. It's still about 6 billion, but its trading volume is doubled. It's about 100 million, right? And there have been days when it's been 600 million. So I think institutions do like it. Now that compares to, if the ETFs are about the market cap of Ethereum is about 1/6 of Bitcoin. The ETFs are only 6%. It's a 6 billion market cap for Ethereum, and it's 100 billion for Bitcoin. So you can kind of tell the bias there. Institutional capital kind of thinks Ethereum's sort of irrelevant. They really only know one thing, which is Bitcoin. But on the flip side of that, you could say, well, that means there's a lot more that it could go up. It's been sometimes a little depressing when I've listened to a lot of institutional investors, crypto investors, which I've never seen because you can't see collectively what all of them hold, but most of them do poo-poo Ethereum. Most of them say we have no exposure or we have very limited exposure. And but I look at that and say, all right, that means there's a lot of dry powder that could get exposure, right? If everyone was heavily invested into Ethereum, that would be troubling because where's the marginal new investor going to come from? It has the characteristic of what I like most. As I've mentioned many times, I've lost most of my money investing in popular things, in the consensus bets. That's where I've generally lost money. And I've almost always made money when I have invested either in out of favor assets or just neglected assets, things people just don't even bother to figure out, right? Well, Ethereum is out of favor. And on Wall Street, I would say it's sort of neglected. It just, people don't think of it as that important. And that means there's not a lot of downside, but if that sentiment should change, you could see a doubling much easier than, let's say, Bitcoin. It's not like people are unaware of Bitcoin. Mm-hmm. The institutions know what that is, and if they're either exposed to it at this point or they've chosen not to be.
Okay, so before we wrap here, William, so you remain long. You're still long. You're unsure of the short term. How much of this pain we're going to get and how long it's going to last. As you said, we're being told that we're going to get more pain. Like, that's the thing that I keep reminding everybody. Trump, Scott Bessent, they're all telling us that they want more pain. So like, more pain is coming. How long that is, how long this goes for, unsure. Could be a few months, could be 6 months, 12 months, a few years. It's difficult to predict that, but you remain long. What we did talk about though was, okay, so if in these uncertain times, and when we see there's there's a move away from, we talk about pumpamentals or meme coins, these,
I like that.
non-fundamental coins versus the utility coins, the fundamental based coins. And there's clearly a move away right now from the casino, from the meme coins, right?
Yeah.
The utility isn't really there yet in the utility
Yes.
coins,
Correct.
right? Now, maybe
Correct.
it's coming because we do have regulation coming that could lead to more buyback programs, more utility coming into place for these token holders, right? Maybe rev share programs. Like, there's a bunch of things that we've all talked about. But what do you do in this time right now as an investor? Are there certain tokens or cryptos that you are looking at and saying, hey, this is where I'm going to be allocating capital and this is where I like to be? Or are you more just sort of sitting on your hands and staying long in what you're in right now?
Yeah. So, well, the market cap, you can't get away from, right? So 80% of crypto market cap is 2 tokens, right? So it's not, the S&P 500, you've got, Microsoft, or might have 3%, 4% of the total market capitalization. Here, it's so overwhelming that if you have crypto exposure, you're going to have it in Bitcoin and Ethereum, unless you, I don't know, you're really sort of wild westing it and you're just going into sort of random stuff. So those are the 2 big ones. And then what we are doing is the majority of our holdings are in those 2 tokens. And then we're sector investors, right? And we've done very well betting on sectors. And as you know, crypto has sectors, right? It was exchange traded tokens in 2018 or such. Prior to that, you had the whole intelligent layer smart contract run. And then, of course, DeFi and metaverse and NFTs all came about 2020, 2021. Being in a sector that could benefit from some sort of blockchain innovation is I think still a smart way to go, because there's these micro rotations within crypto. We saw a little bit of that with AI. And what I would say to people is, if you've been along for the ride so far, you would not want to reduce your exposure unless you literally need the money to pay rent. But that's a reckless way to invest in crypto.
You shouldn't have been investing that money
right.
in the first place.
I've never deviated from my advice on that, which is take your liquid net worth, not your house, whatever, your liquid net worth. And this is for most people. And for your audience, they'll say, you're crazy. That's not enough, but too bad. Liquid net worth and 1 or 2%. That's literally what I tell people, because that's how I would tell people to invest in startups and in venture capital. You take 1, 2%, and because that could wind up going up 5, 10x, and then that's oversized gain. But unless and a 5-year holding period. So a very small amount and a 5-year holding period. I think you're unlikely to lose if you have a 5-year holding period. And so my suggestion is, if you're already exposed to Bitcoin and Ethereum, hang tight, certainly through 2025. And also, what sectors do you like? Personally, I think an area that you could call this quasi-utility, but people love to make money with their money. And this is why chasing yields, right? Looking at mechanisms that allow you to generate something. Now, doing that with leverage has an untold number of risks. So I would say, unless you're very, very careful and you have stop losses, you probably don't want to do that. But if you're already in Ethereum, you should be staking it. It's a 3% return. Why not get it, right? I would never turn my crypto over to a third party to invest. As we saw in the last time around, people irresponsibly lost money by people who weren't careful. I wouldn't do that. But enhancing your yield safely usually, let's say you own a layer one and you're staking your token in that layer one, that has been pretty safe. And you own that token anyway. You're part of the backbone of supporting that chain. That's of course how Ethereum works. You're helping with proof of stake mechanism. Look for that kind of. I think that would be an area where you would see institutional capital also having interest, which provides the liquidity. And otherwise, you have to make an assessment. Do I want to stay in crypto to some extent throughout this supposed bull market run? And you can shift out at some point, but I'll never not have exposure to crypto, even as I get really old. But it'll be less and less, as my risk appetite changes.
Well, you're in crypto, so you're just getting younger. Well,
There you go.
well, all your friends are doing boring stuff. They're getting older. William, absolute pleasure to get you back on the show. Really appreciate your time and giving us the real talk of what's going on in this cycle and how patterns are shifting and changing and how you're positioning yourself. Really appreciate it.
You're welcome.
Thanks for listening in, everybody. We will see you guys back again tomorrow. Before I let you go, got to let you know about the crypto.com card. This is one of my favorite cards in the space. If you want to spend your on-chain dollars on gas and coffee and flights and whatever you're spending day to day, check out the crypto.com card. No annual fees, cash back in crypto on chain. So you're getting cash back in crypto, lounge access, bunch of perks. Check it out. Link is in the show description. Also, this should go without saying, but I need to remind you all that none of this is financial advice. This show is for educational purposes only. So you should do your own research. None of the views or opinions expressed in today's episode from myself or from William represent financial advice. We are not financial advisors. If you want to invest, you should always know that there is risk associated that with crypto or wherever you're investing, and you should never invest more than you're willing to lose, as William said throughout this episode. Thanks again for tuning in, y'all. We'll see you guys again back tomorrow. Have a wicked awesome day.